When it comes to inheritance tax, gifting assets can be a powerful way to make sure your loved ones keep more of the wealth than HMRC gets. But here's the thing, for a gift to qualify as a gift for IHT purposes, it actually has to be a gift. Let me explain. A lot of people assume that once something is given away, it's out of their estate. But that's not always true. If you've ever gifted something like a property or investment, but still kept some benefit from it, you could fall foul of the gift reservation of benefit rules. These rules are there to stop people giving away assets in name only while still enjoying them in practice. If you're new here, I'm Abbas, a chartered accountant and chartered tax advisor. I trained in the private client teams at one of the big 4 firms, and I now work with individuals and business owners on complex tax matters, including residence, business restructuring, and increasingly inheritance tax planning. In this video, I'll break down what the gifts with reservation of benefit rules are and how to make sure that you don't get caught by them. What exactly is a gift with reservation? Let's say you gift your house to your children, but continue to live there, or you give a car to a friend, but you still use it every week. HMRC doesn't see that as a proper gift because you've retained a benefit. For IHT purposes, they'll treat it as if you never gave it away, meaning that when you die, the asset is dragged back into your estate and taxed, even if the gift was made years ago. A recent tribunal case shows exactly how strict HMRC can be. Back in 2000, Mohammed Chughtai set up 2 trusts for the benefit of his children, excluding himself from benefit. One with his £380,000 house and the other with £62,000 Santander bank account. He died in 2017 and his family excluded these trusts from the IHT calculation because they were created more than 7 years before his death. And Mr. Chughtai moved out of the property back in 2000, well before his death, but he then moved back in to care for his son, who was entirely dependent on others. The property also contained a commercial unit where Mr. Chughtai and his family ran a commercial business, and he continued using that address on his tax return. HMRC argued that the trust assets were still part of his estate. Why? Because he had moved back into the property and certain personal expenses like utility bills for him were still being paid from that Santander bank account. The family argued that he only moved back in to care for his son, but the tribunal agreed with HMRC, saying this was a classic example of a gift with reservation. On top of that, the trust was drafted as an interest in possession trust, which didn't explicitly exclude Mr. Chughtai from benefit. So even though these trusts existed and were technically separate, their value, £442,000 in total, was pulled back into their estate for inheritance tax. The HMRC inspector even cited a previous case where Judge Hoffman has famously stated, not only may you not have your cake and eat it, but if you eat more than a few de minimis crumbs of what was given, you are deemed for tax purposes to have eaten the whole lot. The key takeaway, you can't have it both ways. You can't give something away but still keep access to it, whether that's income, capital, or even just the use of it. HMRC will still treat it as yours for IHT purposes. And as Judge Hoffman's quote highlights, even the smallest benefit can disqualify the entire gift. There's no pro rata adjustment. It either qualifies or it doesn't. Just one day of benefit is enough to fail the test. This applies to trusts, properties, bank accounts, shares, anything where you retain a benefit after gifting. This is why proper estate planning needs careful thought. It's not just about giving assets away. It's about making sure that when you do give them away, you don't trigger anti-avoidance rules like these. In this case, the trusts were meant to save tax, but ended up creating a tax bill. We work with clients to optimize their IHT position and structure their affairs properly, making sure that the planning holds up when it matters most, and that they will steer well clear of traps like these. If this is something that you're considering, feel free to reach out. I hope you found this video useful. And if you did, don't forget to like and subscribe for more tax planning tips and insights just like this. See you in the next video.